Most people think they fail at investing because they lack discipline. They think the fix is more self-control, more research, maybe a stricter budget, maybe one more finance podcast in the background while they scroll bad trades. But that is not the real problem. The real problem is that your brain reads slow wealth as boring and fast risk as alive. Crypto pumps, meme stocks, option screenshots, wild price swings, all of that feels like action. A broad index fund feels like watching paint dry in a waiting room with no phone. And that matters more than most people realize. Because if you keep chasing the feeling of action, you slowly train yourself to confuse noise with progress. You start thinking movement means growth. It does not. So in the next few minutes, I want to show you the hidden rule running this whole game. Your real edge is not stock picking. It is changing what your brain counts as a win. You are not broken. You are not lazy. You are not uniquely bad with money. You are using an old brain inside a market built to hijack attention. Your nervous system did not evolve for brokerage apps, price alerts, social feeds, and 24-hour speculation. It evolved to chase signals, sudden movement, uncertainty, surprise. That is where dopamine comes in. People talk about dopamine like it is the pleasure chemical, but that is too simple. The truth is, dopamine cares a lot about anticipation. It spikes when something might happen, when a result is uncertain, when the next click, the next candle, the next alert could mean a payoff. Think about how a slot machine works. The point is not just winning. The point is that you might win on the next pull. That maybe is what keeps people locked in. Now look at high-risk investing through that lens. Crypto, meme stocks, day trades, zero-day options. They are built like behavioral traps. Prices move all day. There is always a chart to check. There is always a new post saying this thing is about to explode. There is always a crowd cheering, coping, posting gains, posting losses. It feels alive because it is feeding your brain novelty, uncertainty, social proof, and the fantasy that one smart move changes everything. That is why smart people still get pulled in. Not because they cannot do math, because the system is designed to make risk feel meaningful. You want financial freedom. That is your intention. But your brain wants stimulation right now. That is the obstacle. And if you do not see the split between those two goals, the stakes get ugly fast. You start building habits that look like investing but act like slow capital destruction. You check prices too much. You make moves to relieve tension, not to improve strategy. You confuse being busy with being effective. And boring index funds have the exact opposite problem. They do not tell a story. They do not make you feel like a genius. There is no hero arc, no tribe, no late-night chart session where you convince yourself you see the pattern no one else sees. Here is the belief you need to break. Excitement feels like opportunity. A lot of the time, it is just cognitive bias wearing a party hat. The more charged you feel, the worse your judgment can get. You anchor to recent gains. You chase what is moving. You read luck as skill. Think of it like this. Most people want to beat the casino. So they walk inside, stare at flashing lights, and start pulling levers. The smarter move is owning the whole casino. Broad funds do that. They are not sexy. They are structural. You stop betting on one loud table and start owning a slice of the machine. You have probably felt this yourself. The market gets loud, your screen turns red or green, and some part of you starts saying, do something. Anything. That urge feels urgent, it feels smart, but acting fast and acting well are not the same thing. And knowing your brain does this is useful, but it is not enough, because the hidden rules reward whatever gives you feedback now. Which brings us to the core strategy. If you want different behavior, you have to change the reward. So here's the real trick. If your brain only feels rewarded when your account jumps fast, you will keep hunting bad setups. You will say you care about long-term wealth, but your actions will keep serving short-term stimulation. And that split will wreck you quietly. The thing is, most people treat investing like an event. They want a hit, a breakout, a win they can point to and say, see, I knew it. But real wealth does not work like that. Real wealth is a system. It is money moving into assets again and again, on schedule without needing your mood. Which brings us to the hidden rules. What gets tracked gets felt. What gets felt gets repeated. If the only thing you track is price, then price becomes the game. If the only thing that feels like success is a spike, then your brain will keep chasing spikes. So you have to move the reward. That means the new question is not, did this thing pop today? The new question is, did I run the plan? Did the auto invest go through? Did I fund the account? Did I keep the right split? Did I avoid a panic move? Did I stay in control when the market tried to turn my brain into a smoke alarm? Build a scorecard. Keep it stupidly clear. Contribution made? Yes or no? Savings rate hit? Yes or no? Allocation stayed on target? Yes or no? No emotional trade this week? Yes or no? Net worth trend still moving up over time? Yes or no? Now your brain has something clean to chase. Think about two people with the same extra cash each month. One uses it like a slot machine budget. He scans for the next hot thing, checks prices all day, wins sometimes, loses often. The other builds a machine. Money goes in on schedule. Broad funds do the heavy lifting. The score is consistency, not excitement. And this works for a very basic reason. Your brain can learn to love streaks, rituals, and visible progress. People keep language streaks, gym streaks, reading streaks, because once progress becomes visible, consistency starts to feel good on its own. Investing is no different. But here's where most people mess up. They try to beat temptation with willpower. They say, I will just stop checking charts. I will just be more disciplined. That almost never lasts because the cue and reward loop is still there. Your brain still knows where the confetti is. So yes, build the better scoreboard. Reward process. Make consistency feel like progress. But even with that in place, there is still one problem. Boring systems stay boring if the payoff feels too far away. And if compounding stays abstract, your brain will drift right back toward whatever feels real today. So now you hit the next wall. Even if you move the reward from outcome to process, your brain still has a bias problem. It discounts distant rewards. In plain words, now feels heavy and later feels vague. $10 today feels real. $10,000 years from now feels like a sketch on fogged glass. Think about it. If I tell you a risky trade might jump this week, your brain wakes up. If I tell you a broad fund will likely help you over decades, your brain nods politely and then goes looking for snacks. The system is designed to pull your eyes toward motion. You need to turn compounding from an idea into something your brain can see. Build milestone ladders. Mark your first 1,000, then the next level, then the point where your money starts buying meaningful chunks of future freedom. Use yearly snapshots. Track total contributions beside total growth. Watch the gap widen over time. A simple way to think about this is planting trees. If you stare at one patch of dirt, it feels pointless. Nothing seems to happen. But if you mark each row, count what is planted, and come back every season, the field starts to feel real. That is compounding. It is boring when it is invisible. It gets interesting when you can see the shape of the system filling in. This is also where identity starts to matter. If your self-image is, I am a person trying to catch the next pop, then every quiet month will feel like failure. But if your identity becomes, I build assets, the whole game changes. Builders do not need constant drama. Builders measure inputs, track structure, and let time stack layers. And yes, you need to celebrate dull wins. First automatic deposit. First month with no emotional trade. First quarter where you followed the plan even when the market got weird. Those are real wins. The hidden rules say behavior grows where attention goes, so put attention on the boring moves that actually build wealth. The truth is, the goal is not to feel hyped all the time. The goal is to feel steady. Calm is underrated because it does not screenshot well, but calm is what lets you think. Calm is what keeps you from turning a normal dip into a dumb decision. So, change the room around you too. Hide trading apps if they keep baiting you. Kill alerts that serve no real purpose. Make your long-term account easy to see and your gambling feed hard to reach. And look at your inputs. If your feed is full of moonshots, hot takes, and fake certainty, your brain will copy the room. So now here's the practical move. Stop asking one pile of money to do two different jobs. Your wealth building money has one job: grow slowly, broadly, and with as little drama as possible. Your impulse money needs its own box. Separate them. This matters because most people keep mixing strategy with stimulation. They use serious money to scratch an emotional itch, then call it investing. That is how good plans get wrecked. By one bad week, one hot tip, or one night where the chart starts looking like a message from the universe. So build two buckets. The core bucket is the real engine. That is your long-term money. Broad exposure, automatic deposits, low friction, fewer decisions. You do not check it all day because its purpose is not to entertain you. Its purpose is to compound while you go live your life. Then, if you know you still want some room to explore, make a tiny fun bucket. Fixed size. Hard cap. No adding more after losses because your ego feels offended. No stealing from the core bucket because a trade feels special. And if the fun bucket goes badly, fine. That is not your future collapsing. That is tuition for curiosity. That split works because you are not trying to become some pure emotionless machine. That is fake. You are giving each impulse the right container. One side of your brain wants stability, the other wants motion. Good strategy does not pretend one of them does not exist. It puts each one on a leash. And once the core machine runs in the background, something weird happens. Market noise loses a lot of its grip on you. Not all at once, but enough. A crazy headline stops feeling like a command. A red day stops feeling like a personal attack. A green spike stops feeling like proof that you need to abandon your plan. That is the deeper win here. You are not just building a portfolio. You are building distance between your money and your moods. And that distance is a strategic advantage because the people who stay calm usually keep more of what they earn. So here's your 3-step move. First, automate one boring investment today. Just one. Second, make a simple scorecard you can check each week, not each hour. Track contributions, allocation, and whether you stayed in control. Third, if you want speculation, cap it hard and quarantine it. Then run a 30-day test. For 1 month, reward yourself only for process goals, not market results. And audit your cues, alerts, apps, group chats, creators, all of it. Ask what keeps pulling you back into the hunt. If you do this right, you get less stress, fewer dumb moves, and more capital compounding while your attention goes back to real life. So now you have the real playbook. Boring investing starts to win when your brain learns to treat consistency as the reward, not excitement. Set up one automatic buy today, then build one visible tracker before the day ends, and drop a comment below. What pulls you harder right now? Slow compounding or the rush of the hunt? If you want the full playbook on building wealth without getting played by your own brain, make sure you subscribe. As Daniel Kahneman put it, nothing in life is as important as you think it is while you are thinking about it.
See you in the next one.